Hello everyone, how's it going? In this video, we're gonna keep updating about Mullen, trading under the ticker symbol MULN. So the company is an EV manufacturing, distribution, and marketing company. It acts as a holding for several brands and companies that they will purchase along the way, the latest one being the Elms and its EV trucks. The current iteration of Mullen began in 2014 as a successor of a company called Mullen Automotive. Another company called Mullen Motor Cars was also founded and was behind the creation of Mullen GT, one of the earliest EV supercars in the market back in 2007. So overall, it's very convincing to say that Mullen has been an EV veteran and has a backstory to kind of like support the fact that it's been around the corner for a long time. Now the question is, one, how relevant is all these, and two, if they have the means to continue to stay in this game. Because here's the thing. It's one thing to say that, oh, okay, Mullen has been in the game for a long time. Another way to say this is that, well, they failed multiple times, right? I remember when I was covering Fisker, I said that it's not always a minus in reality, but it often sounds like a disadvantage when you say that, oh, this is like the fifth iteration or the fourth iteration of the same entrepreneur's ventures. So, I would say that, yeah, it helps the owner, the founder, to avoid some mistakes from being repeated. But it doesn't necessarily please the shareholders. The other question regarding whether they have enough means to continue, well, the obvious answer is if things go on like this, then no. Because, and we're going to talk about this in a second, when we see the financials of the company, even though things are not alarmingly dramatic at the moment, well, they're slowly digging themselves into a hole, right? But of course, all of this might change in the short-term future because they recently secured a distribution deal for iGo in the European market. Now, if we look at the present price action, it seems like there has been some retracement in today's trading session from the peak of around 50 cents, and the market is moving a bit away from that level. This can be explained probably by the tendency to get out of the trade, and also additional shorting pressures could be behind this recent move. We need to see if the trading sessions in the upcoming weeks will give us some additional support, can it stop moving lower? Can it hold it for at least a day and then maybe a week? And then we can start building back from there. But for now, the momentum seems to be put on pause. And we do need to see additional demand for the stock, which could occur if the volume does pick up over time. Speaking of which, I wouldn't say that the demand is much lower now. I mean, it's still about 190 million shares versus 198 million shares. But given the lackluster performance of today's trading session, I would say that maybe it needs to go north of 200 or even 250 million shares for us to start see some steam getting picked back up. Overall, the company has been having I would say mostly bearish and difficult trend over the past 5 years, having traded between $5 to $10 for years before peaking around $15 when everything else was peaking as well. But it fell much harder than the rest of the market. And even then, I would say that despite the fact that it is now in the penny stock territories, the reason why a lot of people, myself included, we were attracted by Mullen was because its volatilities do offer a lot of opportunities. Okay, so this kind of stock can easily yield you 100% plus in terms of profit, but it also means that it could yield you 40, 50, also another 100% loss if you buy it at a bad timing. So was an entry by 50 cents a bad timing in the short term with the benefit of hindsight? Yes, right? But me personally, I've decided to enter around that price point because I figured, one, it's kind of cheap. 2, it's a money that I can afford to lose. And 3, in a situation like this, there may not be any retracements further down the line. We now know that there is. It doesn't mean that this was written on the wall last week. So the online communities along the media outlets, I would say that they're mostly skeptical, but at the same time, apprehensive, right? I think that's the right word. Apprehensive about what's going to happen next. A lot of people are wondering if it has the capacity to turn itself profitable and to also deal with the issue of lack of transparency. So what do I mean by that? Well, we now know that they've got with themselves like a distribution right. Regardless of what we can say about the European economy, not so good, and it has been good for some time now. Although we can say that, who knows what's going to happen with this compact Lego-like car. Ultimately, it is supposed to bring in some much-needed cash flows. Okay, so this is the bottom line. The other thing is, well, with their capacity to be more transparent, Mullen has been having, maybe because it's a penny stock, but even then, it's not supposed to be an issue because they're still listed on NASDAQ. The fact that they can just come out and say, we've secured a big partner, we've secured a big client, we're going to disclose who the person or the entity is, and they've ended up not saying anything about it, this kind of rubs me the wrong way. Another thing was, they talked about how they've secured this distribution deal, but they haven't disclosed who is the manufacturer, who is the partner who actually made those cars, those EVs that Mullen is now kind of the frontman. So I would say that these are the reasons why, 1, I wouldn't invest my money in Mullen in the long term, and 2, I honestly don't think that Mullen is a company that really deserves people's long-term trust. But at the same time, that's not really why we're here. We're here because we see an opportunity to make a quick profit with a short squeeze, right? With short squeeze triggered by some positive catalysts, regardless of how actually positive they might be. I think that by then, things would have already occurred, everything that we have wished for should have occurred for this to not matter too much. Now, at the same time, the trends within the EV sector and growth stocks have been under pressure for some time, but of course, it has been under pressure from a peak. And there are several other factors that can threaten the long-term prosperity of the sector as well. So some of them may include the supply chain issues, the shortage of key components, the valuation model of EV companies. Maybe it's going to switch from a tech company profile to a car manufacturing company, so industrial company, right? The fact that so much value in this, so much hope, is dependent on an almost monolithic existence of Tesla. What if something goes wrong with this company a few months or years down the line, right? What if Elon is no longer the poster child of, I don't know, virtuous capitalism? By the way, he actually is not, right? But that's how he played out his persona. So every single one of these aspects is going to have a certain impact on the long-term outlook for Mullen. And in fact, speaking of which, this is also one of the reasons why Mullen is an interesting company to trade, because it's against the trends. It's not always a company that follows or highly correlates with what the current trend of things is. And that in by itself, in this current moment, where everything seems to be falling, where there's conflicts, where there's higher interest rates, there's the VIX number being pretty high, I would say that can be a pretty compelling reason to take a look at Mullen as a trading position. So with that being said, let's take a look at the finances. When we look at the cash balance, it has increased on a year-to-year basis. So recently it decreased somewhat from 105 million to 84 million. Overall, I wouldn't say that this is a big issue, because if they have money, if they have cash in their coffers, they can fulfill their short-term obligations, and by doing so, they don't have to dilute their shareholders or to take on more debts to do this. And in fact, when it comes to Mullen, I have a feeling that it's mostly going to be diluting the shareholder. That's going to be a real solution. I'm not sure how much more debt Mullen can take on at this current time. Another thing is their liabilities, so the debt. The reason why debts are like relevant to the survival of a company is because if they say that, oh, we cannot, fulfill what's coming due, regardless of whether it's the principal or the interest amount, then the company is considered as insolvent and they would be liquidated. At the moment, the current liabilities, so what's coming due within 12 months, has been increasing over the last 3 quarters. So overall, I would say that this is a bad news because it does suggest that there might be some going concern risk going forward. And indirectly, it also increases the cash flow problems because the more debt you have, obviously, the more interest rates you're going to have to pay off with the cash balance that we've been talking about earlier. At the end of the day, yes, a company can raise cash by just selling their shares, but that's not going to be a very good news for the shareholders. And also, the fact that a company may get liquidated is not a good news either. But overall, I would consider that those risks definitely exist. I wouldn't really say that for the time being, they are existential threats. Okay, so there are other companies that we've covered before, like is it ENDP? So Endo Pharmaceutical or Endo International. That company had a huge amount of debt, and also like a class action lawsuit that ultimately caused the company to go, Chapter 11, I think, and now they're looking for a buyer, which, by the way, is something that we may cover in the future. It's not currently looking any better, but anyway, let's get back to Mullen. So I wouldn't say that the going concern is a big issue, even though it's gonna become. It's an issue that has stayed along, and it's going to be something that'll be more relevant as years go on, especially if they don't have any profitability. And speaking of profitability, they do have a certain control on how they spend their money. So I can see that they try to prevent operating and general expenses from going up. And the fact that they've also increased their research and development costs shows that they want to do better. They want to start making money. They want to roll out models. Okay. But with that being said, since the beginning of 2021, so it's been 2 years at this point, there has been no revenue. So even though the operating losses are not extremely big by themselves, they still keep digging the hole, which will eventually force the company to do something. Either they, like what they did just now. So either they have to secure new revenue streams or roll out models against the clock, or they would have to dilute their shareholders. Okay, so it really means that time's ticking for Mullen. And of course, either way, time is ticking for our positions. Overall, the financials of Mullen shows us that the big picture for the company is that it's doing its best to stay afloat, to control how much cash goes out, because nothing goes in at the moment. And they try to keep everything on a tab. But still, I would say that, positive cash flows from operations need to happen soon in order to avoid further dilutions, possible delisting, and going concern problems. The clientele of Mullen is mostly retail with a twist. So it's mostly similar to Tesla as far as its own like homebrew, homemade models are concerned. It's at a similar pricing point to Fisker, to Tesla, maybe not for Lucid. So, overall, it's like medium and medium high-end clienteles. But it also has a line of cars that it's responsible to distribute in Europe called iGo. So the way that iGo seems to work is that it's a transportation kind of vehicle. It's a small, compact electric vehicle that can help business people and freelancer like workers to send parcels and food deliveries. That's how I see it. And it's smart. It's certainly something that when you pick up vehicles to do this kind of gigs, it's the fact that it's fuel efficient or energy efficient, the fact that it's compact, the fact that it's cheap to begin with, 12k euros. All of these are going to be attractive factors. Now, the big question is, we don't know who made those cars. We have a suspicion of who made those cars, and they want to like commercialize them through Mullen. And so therefore, we don't know how good of cars they are or how bad of a bunch of cars they are, right? So for the moment, there's no way to tell, but I guess time will tell us. And hopefully our position doesn't have to live long enough to be obliged to like follow the course of those sales or the quality issues that may or may not happen, right? Hopefully we're going to be out by then. In terms of the shareholder description, okay, so I still believe that it's mostly retail, meaning they are volatile, they're reactive, and they would buy in or sell out at any whim of significant price action movements. Sometimes the reason I say a whim is, let's say, the stock fell from 50 cents to 40 cents, and then they're gonna sell out, right? So we're talking about this kind of sporadic behaviors, which seems to be common ground for most retail shareholders. So this makes Mullen a good stock to trade and speculate. And also at the same time, I mean, it doesn't mean that any stock with a majority of the shareholders being retail is a bad stock. It doesn't mean that. But we have to ask ourselves questions if we want to hold it long term. There are also some institutional shareholders, and their numbers are increasing. I mean, I recognize this fact. But at the same time, the question is it significant enough for me to change my view on the fact that Mullen is good for trading and not necessarily good for long-term holding and investing? I don't think so. Like, at the moment, I don't think that Mullen has done enough to deserve me to put my money in it for the long run, right? But it has shown, and well, it's not just because Mullen has shown me. I have made 100% plus profits before with Mullen. So I know for a fact that as far as speculating and trading short-term goes, Mullen is a decent choice. Now, overall, like I said before, the risk factors going forward are like the market interest rates, the VIX, the money supply, the conflicts around the world, the supply issues. So fundamentally speaking, these are the things that Mullen would have to, to vanquish in order to do better. There is another major factor, which is the short squeeze. There's a huge short position on Mullen at the moment, and this is why people are like buying up the shares, hoping to squeeze out the short sellers. Because the way that shorts function is that they borrow shares from brokers, they dump it in the market, they hope that the shares will, in the meantime, go lower, and then they buy it back and pay it back to the brokers, netting out a big profit, right? But if the share price goes up, then they would be compelled to quickly liquidate their positions by redeeming those shares at a higher price. Because every single day, as long as those positions are open, somebody is paying financial fees to somebody else, and the somebody else being the brokers. So in order to not make things drag, because the longer they drag on, the more money they're going to lose. So in order to not make things drag, they may be compelled to like liquidate now to avoid even bigger losses. And by doing so, they're going to push up the share price in the meantime. This has happened with GameStop. It has happened with AMC. It has happened with less success with other stocks. But my feeling is, on paper, this could work with Mullen, right? The short positions have not been diminished just yet. And we can see like some kind of probability that this kind of event could happen with Mullen, like a out of favor, cheap EV manufacturer and distributor that the market doesn't seem to like, but for no reason, if people just pile in, they would be forced to liquidate their positions. So this is something that's mechanical and also kind of like a self-fulfilling prophecy. If everyone believes in it, it's going to happen, right? Because they need to avoid further losses, regardless of the fundamentals of Mullen, regardless of how, non-transparent they might sometimes be, so on and so forth. So this is a huge drive behind the reason why some people like Mullen. And will this necessarily happen? I would say that if the volumes continue to be huge, and by that, it's like much bigger than now, then yeah, it's probably going to be a self-fulfilling prophecy. But whether the demand will keep up, this is a whole other story. This is why I would say that, there's a material probability for Mullen stock to be short squeezed. Whether this material probability is certain or even likely, then that's a whole other debate. I personally think that it's worth the risk and also worth the unrealized loss of going from 50 cents to like 40 cents. It's worth the wait to see if people can ride out the current retracement. But apart from that, this is also why you would definitely have to wait and see to see if you should be buying Mullen shares and how much you should be buying it for. Speaking of which, my overall recommendation is, if you fit the investor profile of like you're diversified, you're comfortable with trading penny stocks, you're comfortable with playing the short squeeze or no short squeeze game, then Mullen is for you. And despite the fact that it has retraced to like around 40 cents, I would say that if you want to go in like DCA in by the time it reaches 25 cents, then, that's more than fair. But if you want to hold the stock for the long term, then I would say that we definitely have to wait for next year to see if it manages to roll out any sort of model, right? If it can, then I may change my perspective on that. The maximum exposure I would recommend on Mullen overall should be between 0.5 to 1%. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.